The fifth learning objective is to prepare the trial balance from the T accounts. A trial balance summarizes the ledger by listing all the accounts with their balances, assets first, followed by liabilities, and then stockholders' equity. In a manual accounting system, the trial balance provides an accuracy check by showing whether debits and credits equal. In all types of systems, the trial balance is a useful summary of the accounts and their balances because it shows the balances on a specific date for all accounts in a company's accounting system. Do not confuse the trial balance with the balance sheet. A trial balance is an internal document used only by company insiders and specifically accountants. Outsiders see only the company's financial statements, not the trial balance. Shown here is the trial balance of Smart Touch at April 30th, 2013. The end of the first month of operations created from the balances calculated after all transactions have been posted. Notice the debit totals equal the credit total. Throughout the accounting process, total debits should always equal total credits. If they don't, there's an error and we need to find where it is before we can continue in the accounting process. Errors can be detected by computing the differences between the total debits and total credits on the trial balance. Then you can perform one or two of the following actions. First, search the trial balance for a missing account. Trace each account from the ledger to the trial balance and you will locate the missing account. Secondly, divide the difference between debits and credits by 2. A debit treated as a credit or vice versa doubles the amount of the error. Suppose an accountant mistakenly posted a $500 credit as a debit. Total debits contain the $500 and the total credits omit the $500. The out-of-balance amount would be $1,000. Dividing the difference by 2 identifies the $500 amount of the transaction. Then you can search the trial balance for a $500 transaction and trace to the account affected. Number 3, divide the out-of-balance amount by 9. If the result is evenly divisible by 9, the error may be a slide error. For example, writing $1,000 as 100 or writing $100 as 1,000. It could also indicate a transposition error. A transposition error is reversing 2 of the digits or flip-flopping them around, treating $1,200 as $2,100. Dividing by 9 will find this error for you. Total debits can equal total credits on the trial balance. However, there still could be errors in the individual account balances because an incorrect amount might have been selected in an individual journal entry. So just because it's imbalanced does not mean that it is correct. The journal and the ledger provide details to create a trail through the records. The journal should always have the following parts: the date of the transaction, the accounts and the amount debited and credited, and the posting reference. This indicates whether or not the entry has been posted to the ledger. Posting means copying information from the journal to the ledger. This diagram shows the posting process. Number 1, you're putting the date in the ledger. Number 2 is the amount. In this case, it's a debit of $30,000. Goes in the debit to the ledger. Step number 3 is the account number that goes back to the journal. And step number 4 is the journal page number. The ledger accounts illustrate previously appeared as T accounts with the debit on the left and the credit on the right. The T account clearly separates debits from credits and is used for teaching, but there isn't much detail. Another account format has 4 amount columns, as illustrated here. The first pair of debit-credit columns is for the transaction amounts posted to the account from the journal, such as the $30,000 debit. The second pair of amount columns shows the balance of the account as each date. For this reason, the 4-column format is used more often in practice than the T account. Cash has a debit balance of $30,000 after the first transaction and $10,000 balance after the second transaction.